Thinking like me, we hold Bitcoin because we believe truly disruptive technology that will continue to increase in value and has the potential to replace the dollar as the world reserve currency. Despite this being the case, there may come a time when it makes financial sense to access some cash from your Bitcoin holdings. Unfortunately, selling Bitcoin in certain countries like the good old US of A, where I live, incurs capital gains taxes. Those looking to avoid having to sell their Bitcoin and be subjected to these taxes, Bitcoin loans are an option to get the dollars needed without having to make a sale. While Bitcoin loans may not be for everyone, they can be an excellent way to monetize one's unrealized capital gains on Bitcoin in a tax efficient way. For today's episode, we're going to discuss what a Bitcoin loan is, how a Bitcoin loan works, and some important factors to consider when looking to get a Bitcoin loan. Let's get started. Welcome to Crypto Talk Tuesday. I'm your host, Mario Johnson, and I am also the president of Crypto Scholars LLC. And tonight, I'm going to be your guide on this journey to better understanding crypto-backed loans. Our focus will be on Bitcoin-backed loans, but the same logic can be applied to any type of crypto-backed loan. Before we begin, I have to let it be known that the information we're about to discuss is for educational purposes only. None of it should be construed to be financial, legal, or tax advice, as everything in this video is solely the opinions of myself. I am not a licensed financial advisor or registered investment advisor, so please do not buy or sell anything based on my opinion. Many cryptocurrencies possess considerable risk of loss. I myself do not guarantee any particular outcome. So now that's out the way, let's talk about these Bitcoin loans. All right. So what I was going to do is I was going to basically just kind of sit here and talk and give you guys the rundown on exactly what a Bitcoin loan is, but I decided to do something different. I actually created a presentation for you guys. Take a look at that. You see that? That's the presentation I created. So what we're going to do is we're going to go through the presentation, and I'm going to give you guys the, kind of what I was looking to do, the exact rundown of what a Bitcoin loan is, how Bitcoin loan works, and I guess the factors to consider in regards to taking out a Bitcoin loan. Certain things, certain questions that you may want to look into, certain things that the differences between a Bitcoin loan where I guess the lender does full custody versus a lender that does multisig, so that you're not relinquishing all of your crypto over to the lender, trusting them to not relend it and also to keep it secure. So those are the things that we're going to talk about when we get going with this. So I'm being told that my audio sounds a bit funny. Give me 1 second. Let me check everything out and make sure I don't have any issues as far as that goes. Hold on, y'all. Hold on. Oh, that's why. I see. You're not using the correct microphone. There we go. All right. Let me know if you guys can hear me a little bit better. I didn't have it set to the correct microphone, so that's my apologies there, guys. All right, so we're going to try this again. I know I was being told that it was a little bit choppy. So what we're going to do is I'm basically just going to let it be known one more time that the information I'm about to provide and the information I'm about to discuss is for educational purposes only. None of it should be construed to be legal or financial or tax advice, and everything in this video is solely the opinions of myself. I am not a licensed financial advisor or registered investment advisor, so please do not buy or sell anything based on my opinion. Trading cryptocurrencies possess considerable risk of loss, and I myself or Crypto Scholars as a company do not guarantee any particular outcome. All right, so now that we got our audio situation taken care of, let's get into the presentation that I cooked up for you guys. First and foremost, let me turn the sound off on my phone because we don't need any rude interruptions. All right. Switch on over to our presentation. You see that? I actually put this presentation together for you guys. I feel like I accomplished something here. So, getting started with crypto loans.
what is a Bitcoin loan? What is a crypto loan? Again, our focus is going to be on Bitcoin backed loans, but like I said before, the same logic applies to any particular type of loan. So a Bitcoin backed loan, uh, Bitcoin backed US dollar loans may be a good option for those who have held Bitcoin long term, have a relatively low tax basis, or just needs access to some additional dollars. As Bitcoin becomes a larger share of people's overall assets, many holders would like to improve their lives by accessing the liquidity from their Bitcoin gains. Unfortunately, much of the legal financial system still does not recognize Bitcoin as a viable asset for many financial services. This is where companies like Unchained Capital, BlockFi, which I personally use, Celsius, and others can assist through what's known as a Bitcoin loan. So the question remains, what is a Bitcoin loan? Well, in short, a Bitcoin loan is simply a loan backed by Bitcoin as collateral. There's no credit check. There's no credit check involved, and you do not have to do a sales pitch about you, your business, or your family to a banker or a group of investors in order to get it. Currently, these types of loans aren't available through any other traditional banks, but who wants to go through a traditional bank anyway? I ain't gonna trust the bank with my crypto. Now, why take a loan using Bitcoin as collateral? Well, a Bitcoin loan allows holders of Bitcoin the ability to use their Bitcoin as collateral. They get to take out a loan in US dollars without missing out on the potential long-term gains of holding Bitcoin. Also, taking a loan against your Bitcoin can offer some very interesting benefits if you're holding a significant amount of Bitcoin, you expect the value of Bitcoin to increase, you have an immediate need for cash, you're looking for tax efficient access to that cash, and you want to make a large purchase. Now, collateralized Bitcoin loans can be a great way to enjoy your profits while still maintaining full exposure to Bitcoin's potential upside. Basically, if the price of Bitcoin goes up, you're not going to miss it because you end up selling because you ran into a situation where you want to make a large purchase. Now, if you borrow in a conservative way, you should still be fine during one of Bitcoin's large dips in price because Bitcoin is extremely volatility. But we'll discuss the possibility of a margin call and what happens in the event that is triggered a little bit later. Now, how does Bitcoin loans work? Well, like we discussed earlier, Bitcoin loans are similar to traditional secured loans, except they use Bitcoin as collateral. And like we said, they eliminate the need for credit checks. The typical process of setting up a loan requires you to, one, create an account, complete some sort of onboarding KYC, which all stands for Know Your Customer Verification. Basically, when you submit your driver's license, proof of like your address, like a bill or something like that. And then you begin the process of submitting the loan application. Next, the lender, like we talked about BlockFi or Celsius or Unchained Capital, one of those particular Bitcoin loan providers, will then provide you with the loan agreements. And once they are signed, they provide you with a Bitcoin address for depositing the loan collateral, which is basically the Bitcoin. Now, after that, you then send your Bitcoin to the address provided, and upon confirmation of receipt, they fund your loan by dispersing US dollars to your bank account the next business day. Typically, this process takes about 1 to 2 days from start to finish for the funds to actually hit your account. Now, like I said before, I actually utilized this through BlockFi because I wanted to make a fairly large purchase, but I didn't want to sell my Bitcoin because, of course, we all know that Bitcoin has the potential to increase in value. So what I did was I utilized BlockFi's collateralized loan service, and I was able to take out a loan through with my Bitcoin. Currently, at the time that I did the loan, Bitcoin was at about $30,000. So it's all pretty much almost doubled. It had doubled when Bitcoin reached an all-time high in value, but of course we had our typical Tuesday where Bitcoin retraced in value. So needless to say, as we said before, I firmly believe that the value of Bitcoin is going to continue to increase, which is why I had no issues with taking out that loan using Bitcoin as collateral, because over time it pretty much pays for itself. All right. Now, here are some factors to consider when you're thinking about getting a Bitcoin loan. Now, one of the factors is custody risk. Now, Bitcoin is what's known as a bearer instrument. So what that means is whoever controls the private keys to the Bitcoin controls that Bitcoin. As many exchange hacks over the years have taught us, there's no guarantee that a custodian won't lose your Bitcoin. Now, because of this, it is extremely important to understand where and how your Bitcoin is stored, and be sure to ask any Bitcoin load provider how the Bitcoin will be secured. Now, one of the most secure ways to obtain a Bitcoin loan is to go through a company that utilizes Multisig. We'll talk about that a little later. But what happens in this case is when you take out a loan, you're then issued one of three keys. Now that ensures that your assets are segregated in a dedicated multi-signature address, and that the assets remain in your title. Basically, you still own them. This also means that the loan servicer is unable to lend out your collateral to others for any additional yield. This process is commonly referred to as rehypothecation. We'll talk about that a little later bit also. Now, in this way, it minimizes the counterparty risk for the custody. I'll start it again. In this way, it minimizes the counterparty risk for the custody of your Bitcoin and eliminates the possibility of socialized losses, which is a common occurrence for losses from rehypothecated trades. So basically what that means is, say like you deposit your Bitcoin as collateral to a particular lender. What that lender in turn does is they re-lend your Bitcoin out. Kind of like how the bank works when you deposit your money into the bank and they turn around and lend that money back out. What is it? Fractional reserve lending, I think is what it's called. And then what introduces the risk is if, say, for some god awful reason, there's a run on the bank. And everybody's coming to withdraw, the money from the bank, including yourself, because you need cash, for some crazy reason. The economy has crashed, and everybody's trying to get their dollars. Well, due to the fact that the bank has relent out your dollars, they don't actually have it in their possession. So that puts you at risk because you need your dollars now. So like I said, that's what's referred to as rehypothecation, and that's something that you, if at all possible, definitely want to avoid when looking to or when you're evaluating a company in regards to doing a crypto-backed loan. Now, an example of how multi-sig custody works, and what we're going to look at is, say you the borrower, say we're going to refer to you as the borrower, and again, you're applying for a crypto-backed loan. So what you do is you submit the application, tell them exactly the amount of money that you want, and they in turn will go back and approve you for said loan. Again, you don't have to worry about a credit check. You don't have to worry about, giving a reason why you want the loan. They may ask you to fill out, a quick little questionnaire, but it's all optional for the most part from what I've seen. But needless to say is once you start that process, you're going to send the Bitcoin to the dedicated multi-sig vault, which is where you issue the one of three security keys. And then, like we said before, you get to retain the title of your Bitcoin. Basically, you get to retain possession of the Bitcoin. Now, you provide one of the keys that's used to generate the multi-sig address for the loan. In essence, the next step in the loop is the lender. They are also given the second key, and then there's a third-party key agent who holds on to the third key. Now, for any transaction to take place, two of the three parties have to sign that transaction with those issued security keys. And also, all parties must use an offline hardware wallet, which I talk about all the time. My ledger, I live by these things, but they have to use one of the hardware wallets in order to provide the keys and to sign transactions. Now, in this multi-institution 2 of 3 model, it significantly enhances security for everyone involved. Like no one person or organization can threaten the collateral, which, like I said, it provides enhanced controls for a few different scenarios. One, in collateral liquidation events, the third-party key agent will confirm through out-of-band communication prior to signing any transactions. Now, if the lender, basically the people you're borrowing the money from, ever fails to perform their contractual obligations, the third-party key agent will work with you directly to release the collateral if necessary, or if they go out of business. Say for some reason the company folds, your crypto is not at risk because again they don't 100% control it. You and the third party key agent can't communicate at that point, and you can get your crypto put back into your full possession. And then also the third party key agent provides a backup to either you or the lender in the hopefully never happening event that someone's key becomes lost or compromised. Now, let's talk about rehypothecation. Now, this is where I was kind of giving you guys the explanation before that introduces a huge risk in regards to taking out a crypto-backed loan. So, rehypothecation is a practice where banks and brokers lend clients' assets that have been posted as collateral. By doing so, the client assets are put at risk, and the bank or broker earns interest by relending their assets. In the case of Bitcoin loans, many Bitcoin loan providers take their clients' Bitcoin, which serves as collateral to a dollar-denominated loan, and lend those assets out to third parties, typically hedge funds and major institutions. Now, as a part of this process, the Bitcoin loan provider is earning interest from both the interest payments of the borrower, yourself, and the proceeds of lending lending your collateral to someone else. Again, either another potential borrower or a hedge fund or a major institution. Now, the lender will often pass a portion of this interest onto the borrower of dollars, yourself, in the form of a marginally lower rate. Basically, they'll try to give you a lower interest rate because they also know that they're collecting interest from relending out your crypto. So if they say, hey, we're going to give you, it's extremely competitive, like the lower rates, please ask them if they're rehypothecating your crypto, because that could be a red flag. Now, many of us who look to borrow, we're not aware of this risk, and it is rarely discussed or disclosed prominently. Through rehypothecation of collateral, a borrower of dollars is being exposed to multiple layers of counterparty risk. Now, working with the lender that is rehypothecating means putting your Bitcoin at risk. I know I've said that a million times, but I really want to emphasize that. Ultimately, you should make an assessment of not only the credit risk of the lender, but also the credit risk of the borrowers to which the lender is lending the rehypothecated collateral. By using a lender who rehypothesizes God damn, why is this word tripping me up? I don't know. But anyway, by using a lender who rehypothecates collateral, you're accepting the risk that either the lender or the borrower of the rehypothecated collateral becomes insolvent, leading most likely to socialized losses. Now, let's talk about different types of insurance that are held on Bitcoin loans. Now, many Bitcoin companies advertise that Bitcoin collateral is insured, which is a good thing, but since Bitcoin is a bearer asset and transactions are irreversible, insurance can be very tricky and often doesn't provide adequate coverage. Holding private keys is generally the best insurance in Bitcoin, which is what we talked about earlier in regards to utilizing a multi-sig type situation. Now, I'm going to give you guys a few questions that you should look to ask a loan provider whenever you're wanting to identify exactly what is covered by their particular insurance. One of them is rehypothecated collateral insured for loss? Basically, if they relend your crypto, if they relend your Bitcoin, and for some god awful reason, like I said, one of those run on the bank type scenarios happen, is your collateral insured? Also, what percentage of total funds are covered by the insurance? Is it only hot wallet funds, or are cold store funds also covered? Next thing you should ask is, what type of loss are covered? Does the insurance company pay users back in Bitcoin, or the value of the Bitcoin at the time of a loss? That's huge. That's really big, because I looked at some companies who do the Bitcoin 401ks, the crypto-backed 401ks, and in reading the fine print, it comes to find out that when you actually do retire and they start paying out, they don't pay it out in crypto. You can't actually take custody of the crypto. They'll only pay it out in US dollars. Well, what am I? I'm 42 years old. So my Roth IRA retirement age, I think that's about 55. They keep pushing it back. So it may even be 60 right now. But let's just say 20 years from now, I'm looking to retire. Well, what if 20 years from now, the US dollar has taken a turn to like the Turkish lira, or it's taken a turn to the Venezuelan currency, to where it's basically been hyperinflated to infinity and beyond, and it's pretty much worthless. You know, I don't want to receive my, payments for my retirement in that particular denomination. I want to receive the crypto because crypto is universal. There's a ton of trading pairs with a ton of different currencies across the world, and I can go anywhere and use it for anything. Who's to say I can still use the US dollar for anything at that point? Like I said, it may be worthless. There are a ton of places right now that won't accept Venezuelan money. There's a ton of places that won't accept it's in Nigeria, Zimbabwe. There's a ton of places that won't accept Zimbabwe currency, because of the fact that it's hyperinflated, to the moon and back and to the moon again, and it's worthless. So, not to say that I see that happening, but just looking at examples of what happens when hyperinflation takes over. As we all know, right now, when they say the printing press is going burr in the United States, I don't know what the plan is. It looks like they're definitely trying to inflate away the dollar, but needless to say, I would rather take possession of the asset versus what's it's denominated in, because again, I can use that anywhere for anything, trade it out. It's kind of like gold. You can take gold anywhere and somebody's going to accept it. Doesn't matter what part of the world you're in. Same thing for Bitcoin at this point. You can take Bitcoin pretty much anywhere, and you can utilize it as a form of barter, as a form of payment for anything, literally anything. But anyway, not to get too far off track, you guys know I love to go down those rabbit holes. Last question you will want to ask is: Does the insurance provided by a third-party custodian cover any hacks or internal compromises which may occur on the side of a lending counterparty? Now, these questions are extremely important to ask and are usually not covered adequately by insurance. A new currency like Bitcoin comes with an entirely new security paradigm that can't be duplicated using the same tools from the existing system, which is why places like Unchained Capital believes the private key ownership is the safest way to offer financial services. You guys going to look at, you're going to hear a term, not your keys, not your crypto. That's huge. It's kind of like what they say. I think from back in the day, we used to be said possession is 99%, 99 or 9/10 of the law. Possession is 9/10 of the law. Basically, you have it in your hand, you own it. And then at that point, the other person has to prove if it was taken from them, that you literally took it from them. Same scenario with crypto. Not your keys, not your crypto. Who wants to go through the hassle of trying to fight a legal situation, proving that something is yours? It's a lot easier on the blockchain because you can verify, transactions and things like that. But why do you want to go through the hassle? If you can hold possession of those keys, keep possession of those keys, and life is great. So anyway, now let's talk about loan to value versus collateral to principal. But this is very important. Now, the loan to value requirement is an important metric to consider when taking a Bitcoin backed loan. Generally, it would be good to stick around 40%. I know BlockFi will let you do as much as a 50% loan to value, which basically means the amount that you're looking to take out needs to be, you have to give collateral that's twice as much, at least 50% more than what you're looking to take out, as it kind of helps if there ever was like a serious dip in price, and it kind of helps give you a little bit of a buffer for a potential margin call. But needless to say, we'll stick with Unchained Capital's rate, which is 40%. So at 40% LTV, this means that a $10,000 loan requires $25,000 worth of Bitcoin used as collateral at the time that you're looking to take the loan out. Now, as I said before, this ratio helps prevent collateral liquidation during normal market fluctuations, kind of give you a little bit of a buffer. Now, like I said, some companies offer lower interest rates at lower LTV ratios. For example, you can do a 20% loan to value ratio, meaning that, say, if you had $100,000 worth of Bitcoin, you could utilize the 20% loan to value and only take out $20,000, which gives you that 80% buffer in regards to kind of shield you from any fluctuations in the price. Now, this means that their clients are depositing far more Bitcoin, kind of like what I said, you're giving them more collateral for a lesser of a loan. Now, some companies do this so they can rehypothecate, which is what we talked about before. You want to be conscious of that. You don't want to do that. But they do that so they can rehypothecate the collateral to those interested in borrowing Bitcoin. And other companies ask for lower loan to value because, like we said, it's a lower risk for the company to lend since they have more collateral. Now, going over to the collateral to principal, now that ratio is the inverse of the loan to value ratio. So a 40% loan to value means that you have a collateral to principal of 250%. Now the CTP is what they refer to it as. The CTP ratio makes it easier for places like Unchained Capital. It makes it easier for their clients, which would be you, to understand the current status of their collateral ratio, especially during a drop in the Bitcoin price. So let's get to the good part. Let's get to the juicy part. Let's talk about the tax implications that may be involved when it comes to doing a crypto-backed loan. So like I noted in the beginning, me nor Crypto Scholars provides tax, legal, or accounting advice. And due to the complexity of the tax law and changing legislation, you should definitely consult with your tax professional regarding your specific circumstances. The information contained is for informational purposes only, educational purposes only, and does not constitute as tax advice. Please, guys, remember that. I'm not giving you tax advice. I'm basically just saying the different options that could be available to you by doing a crypto-backed loan as opposed to selling your crypto. So first question that we want to address is, what are my tax liabilities when taking out a loan backed by your Bitcoin? So in traditional lending, if using an asset like a home as collateral for a loan, the IRS does not claim that asset to have been sold. So the homeowners are not subject to capital gains that a sale might trigger. And we all know capital gains, if it's less than a year, I think it's 35%. Currently, they may have changed that, and then over a year, it kind of goes down, as you progress in the amount of times you had it. Now, taking out a loan is usually tax neutral because it's considered debt, and they don't tax debt. But that is with respect to the collateral. So even if the value of the home has increased, we're using homes as an example, even if the value of the home has increased, using it as collateral for a loan is not a sale, and therefore you're not required to pay capital gains taxes at the time of the loan. In the crypto lending space, the IRS has not given explicit guidance, but the treatment of crypto-backed loans will likely be analogous to traditional lending. Now, in March of 2014, the IRS stated that virtual currencies should be treated as property for tax purposes. So in that regard, on that statement alone, you could relate crypto primarily, I think it was Bitcoin and Ethereum that they identified specifically as being related to as property. So you could compare that to a house or a car or something to that regard. Now, as with traditional lending, the use of property as collateral should not be considered a sale. Therefore, borrowing against cryptocurrency should not trigger capital gains taxes, which is amazing. I'm 100% for that. Like I said, I learned this, and I'm gonna segue for a second here while staying on the same topic, but I learned this trick by studying how wealthy people get around paying taxes. It's called tax avoidance. It's not tax evasion, because tax evasion is illegal, but it's tax avoidance, which means there are certain loopholes put into the tax code, which helps you kind of avoid having to pay taxes in a particular category. So what I found out was that the wealthy people how they avoid paying taxes is they never sell their assets. They never sell their generally they're in real estate, but for the most part they don't sell any of their assets. They just use them as leverage, which is kind of what we're talking about here, and they live off of lines of credit. I think Elon Musk was a great example of that, where he had no cash. He's one of the richest people on the planet, but all of his wealth was tied up into his assets, his companies and other things that he owned. So when it came to actual cash on hand, he was cash poor. Asset incredibly rich, but cash poor. So what he does is, and others, I'm just kind of using him as an example, but they'll basically use their assets as collateral and take out lines of credit, and knowing that the assets are going to continue to increase in value. So you don't pay any taxes, you retain ownership of your assets, and they continue to increase in value. So when we'll talk about this a little later on too, I'm kind of jumping the gun a little bit, but to help further this example, when the loan matures, when it comes due, you have the option to roll it over, especially if it's increased, in value. Say it's doubled in value. So now you can take out the same, we use 20% for our example in the beginning. Say you had took out a 20% loan at $100,000. Now, I'm sorry, say you took out a loan that was for 20%, using $100,000 as collateral. So you basically took out $20,000 of a loan. Now, when that loan matures and is due, if that asset has doubled in price, you now have a $200,000 asset. So you can take out another 20% loan, basically kind of roll that loan into a new loan, which in turn, 20%, $200,000, $40,000. You can take that $20,000, pay off the original loan, and now you still have $20,000 to quote unquote live on in this example. So that it's amazing how that works. When I caught wind of it, I was like, oh my God, why haven't we been doing this forever? But it's kind of one of those tricks of the trade that, they give you the information. Because one thing I've noticed about a lot of wealthy people, they will tell you exactly how to do something. They're more than forthcoming with how to do it. But most people don't do it. I don't know if it's because, they look at it as, oh, they're just talking trash. I don't know. But the bottom line is, it's an amazing tool, it's an amazing thing to have. Now, going over to the next question. Now, are loan interest payments tax deductible? This one gets a little tricky because the IRS has yet to issue specific guidance surrounding interest payments in crypto lending. However, we can begin to get a better idea for how they may be treated by, once again, looking at traditional lending. To understand whether interest payments are tax deductible, it is necessary to consider whether a loan is used for personal, investment, or business-related purposes. If a business takes out a loan for a commercial purpose, the interest is typically treated as a legitimate tax-deductible business expense. On the other hand, if a loan is taken out for personal reasons, interest expense is usually not considered tax-deductible. However, if an individual borrows money to purchase a piece of real estate, because the government loves people who buy real estate, that would produce investment income if you're buying it as an investment property, not as a primary residence, the interest they pay on their loan may be considered investment interest expense, which may be tax deductible. Now, for more information on whether an investment interest expense is tax deductible or not, you should definitely consult with your tax professional in order to get true clarification on that. Next question you may want to know is, what are tax implications if the lender sells my collateral, such as during a margin call? This is what we were talking about before, about those margin calls. Now, during a margin call, borrowers can choose to either deposit additional collateral or pay down their principal to readjust their loan to value ratio to required levels. Now, in the rare case of a liquidation event, which occurs when a borrower has not been able to deposit additional collateral or complete the transactions necessary to repay the principal, margin call and/or the value of their Bitcoin collateral falls to a collateral to a principal ratio of about 110%. The lender would be forced to foreclose and sell on behalf of the borrower to recover the amount owed on the loan. This would be treated as a property sale for income tax purposes, and you may be liable for capital gains tax based on the sale price and value at the time of the sale. So basically what that means is, if for any reason you, I guess, default on your loan, or if the price of Bitcoin or whatever crypto you're using as collateral drops below the required loan to value ratio, they would then initiate a margin call. And then your options are to pay additional collateral to, I guess, bring the loan to value ratio back within an acceptable range, or they'll be forced to sell your crypto. And if they sell your crypto, you're going to be liable for the capital gains tax for whatever price it is at the time of the sale. So that's definitely something to consider when you're thinking about the potential of that happening. Now, next, we're going to talk about Bitcoin price volatility. This kind of plays into the question of how can a margin call get triggered? What happens in the event of a margin call? So the question that would be is, what happens if the price of Bitcoin increases during your loan? So some lenders allow excess collateral to be refunded and returned to the client at an address which is fully under the client's control. So if the price of Bitcoin increases so that the CTP ratio exceeds 300% in a particular example, the borrower can withdraw collateral until the CTP ratio is back to the original 250%. Collateral refunds are supported. Generally, you can do that once a month, although it is good practice to keep extra collateral in the event that the price of Bitcoin drops. Again, we talk about that volatility. Now, you can also move the refunded Bitcoin into a separate multi-signature vault address where you hold 2 of the 3 keys, or into another Bitcoin address of your choosing. Now, the next thing that we would ask is the inverse. What happens if the price of Bitcoin drops during the I don't know why I can't figure out the word I want to use right there. During the time of your loan, I guess is the best way to say it. So, as we all know, Bitcoin is a volatile asset. So the CTP of a loan constantly fluctuates. Lenders set loan terms to adjust for these price fluctuations, but at some point, if Bitcoin drops too far, borrowers will need to post additional collateral or pay off part of the loan's principal as part of a margin call, kind of what I explained before. Now, getting a little bit deeper, a margin call means that action must be taken in order to get the loan back to a required collateral position. Now, we're going to use Unchained Capital because I like using Unchained Capital because I think they have one of the better programs in regards to crypto lending. I told you guys, which I'll show you, I have my account with BlockFi right now, but that was prior to me doing additional research and finding out about, the more secure options that were available for me in regards to doing crypto lending. But going with Unchained Capital, for an Unchained Capital loan, the margin call process begins at 150% CTP. In the event the CTP ratio of a loan hits 150%, a borrower must either deposit additional Bitcoin collateral or fund a partial repayment of the loan principal to improve the CTP ratio. Now, if the price of Bitcoin drops further, it causes the loan to decrease to a CTP ratio of 135% or less. The time to respond to the margin call is accelerated. Borrowers then have 4 hours to either deposit additional Bitcoin collateral or fund the partial repayment of the loan principal to improve the CTP ratio. Now, in the most extreme Bitcoin price drop, you must immediately liquidate the loan at 110% CTP. This is, for the most part, that's the worst case scenario. But you still have to follow that rule without exception, basically to ensure that the lender can continue to lend to clients in the future. Kind of ensures they don't go out of business. Now, one thing that we will say that in regards to, I guess, funding your loan, if for some reason a margin call is activated, I would recommend Again, not financial advice, but in my opinion, I would do it via means of just depositing additional crypto, because those transactions take place not necessarily instantly, but they take place much faster than it would be than trying to do an ACH transfer. As we all know, ACH transfer, depending on the time of day and the actual day itself, could take anywhere from 3 to 5 business days. If this happens on the Friday, and you try to initiate the ACH payment Friday evening, it's not going to even get recognized until Monday, which means that it probably won't get transferred over till Tuesday or Wednesday at the latest. And what if it's a holiday? What if it's an extended holiday? There's so many different scenarios to take into play that could cause that to be delayed. So, if for some god awful reason, there's a margin call that takes place, I would basically just say, deposit some more crypto, because we all, at this point, if you're this deep into the game to where you're doing a crypto backed loan, you know how to open up your Coinbase app, you know how to go to Binance, you know how to, hell, even on Cash App, buy some Bitcoin real quick, and you can instantly transfer it up. So there's really, for me, that would be the best way to do it. Now, what I want to do, this is pretty much the end of the presentation for that, for this particular session. So what I want to do, as always, is kind of open the floor up to any questions that anyone may have. Also, I wanted to kind of, I was going to show you guys my BlockFi account, because as with everything I do, very transparent. And I kind of like to let you guys know that I'm not recommending you something that I'm not doing myself. Coming up here, we're looking to purchase some real estate, and I'm going to do another loan. But I'm definitely going to do, 9 times out of 10, I'm going to do it through Unchained Capital, mainly because of the fact that, again, they have much better security. So I like their program a lot better. With BlockFi, you have to send them the crypto, and I don't like that. I don't like that at all. So I don't have custody of my crypto anymore dealing with BlockFi. So that was something that, again, I wasn't made aware of, but now we know. And what they say, when you know better, you do better, right? So we're gonna start doing better. But anyway, I wanted to, like I said, go ahead and open the floor up. If anybody had any questions, wanted to give you guys the opportunity to ask your questions. You can raise your hand or hit the little hands raise. For the people on the webinar, on the Zoom call, you can hit the little raise hand option, and it'll allow you to ask your question. And you can also type your question into the Q&A section on the Zoom call. So that's another one. And let me see what we got here. And if we don't have any questions, I guess I did my job. I did a really good, hopefully I did a really good thing of explaining to you guys kind of how the, Bitcoin backed loan process works, and giving you different options in regards to where you can go to take out a Bitcoin backed loan. So real quick, doing that, I will pull up the site that I talked to you guys about, Unchained Capital, so you guys can see that. Their website is unchained-capital.com. It's really, like I said, in reading about, kind of what they do and how their process works, I really, and I'm not paid by them, by the way. This is not affiliated in any way, shape, or form. I just don't want to tell you guys about something that I'm not going to do. I myself am not going to do. So looking at, again, the way that they process their loans, the way that they, the security measures that they have in place and that they take, I really feel a lot more comfortable utilizing them. But nothing wrong with BlockFi, because we all like BlockFi too. And let's see. I see Jesse has a question. Let's see. Topic in the presentation, but what are the fundamentals to look at with crypto, and what drives price action? Okay, cool. So what I'll do, Jesse, if you can hear me, I'll go ahead and open you up so that you can talk. So you can kind of give a little bit more detail on your question. Go ahead and unmute yourself, man, and so you can ask your question. Can you hear me? Are you talking, Jesse? If you're saying anything, we can't hear you. No, still can't hear you, man. All right. So what I'll do is I'll basically just take your question that you put into the in the Q&A, and I'll just kind of give a quick breakdown of it. So the question was, what are the fundamentals to look at with cryptos, and what drives price action? Great question. So I'll give you kind of my process on what I use when I'm evaluating different crypto projects, and we can kind of go from there. So first thing I look at is I ask myself the question of what's the use case? Is there a true real world use case for this particular project? And also, what problem are they solving with this particular use case? So, when you answer that question, like I always use Theta as an example. Theta is a really good project, and they're solving a really good a real world problem in regards to bandwidth. What they're doing is something kind of like a bandwidth sharing. They actually, I think they got 2 patents now on their technology in regards to their bandwidth sharing setup, so that if anybody who's running like a was it it's not a valid, it might be a validator or a guardian. It's not a validator. I think it's like one of their guardian nodes. And if you're running the Theta Edgecast, that's what it is. The Theta Edgecast is a software, and what it does is it allows your computer to process particular jobs. If it's encoding a particular video or anything that they have queued up that needs to be done, it can utilize your system for that. And also too, it can allow utilization of your bandwidth to help with their streaming. So it's not 100% reliant like with YouTube. It's 100% reliant on YouTube's bandwidth in their particular, in Google's particular data centers. So if there's any point in failure with one of their data centers, it's either going to slow you down or it's going to completely knock you offline. So they have a true use case. They have a true real world use case. So they answered that question. The second, another thing I look at, I don't know if that's second or third thing. I kind of lost my count. I think that's the third thing. But another thing I look at is how transparent one is their documentation, and also two, how transparent is their team. Do I gotta literally go search through it for a needle in a haystack in order to find information about, who's heading up their team? Like, who's the CEO, who's the CTO, who are the lead developers, who's working on this particular project. If I gotta, search, through, I gotta search through, go through leaps and bounds to find out who these people are, that raises a red flag for me. Also too, I look at the tokenomics. When the project first came out, when it's first launched, how were the tokens distributed? Is it a situation where the bulk of the tokens were given to early investors? And if so, what's their lockup period? Like what are the terms in which they can, potentially cash out? What are the terms in which they can sell their Bitcoin? I mean, sell their crypto, sell their holdings, because the last thing you want is to have a company dump on you, in regards to as soon as it goes out, there's this huge pump, but then it's followed up by a dump. We don't want that to happen, so how is it, how's the tokens distributed, and kind of like I think Yearn Finance was one. We were real skeptical about it when it first came out, but it was later revealed that the creator of it, he literally put every coin out into circulation. Like he didn't hold any coins. He didn't really didn't do anything as far as self gain. He created the project and released it, and created a smart contract, and now it's out. It's doing its thing, and he gained nothing from it. That's something that you can trust in regards to how you kind of evaluate a project. They're not, they're not being greedy. They're not giving the bulk of their holdings to anyone other than the community. That's a really good thing. Let me see. All right, so Jesse did drop off, so he may have ran into some issues in regards to how he was connected there. But hopefully that answers your question, man. Now, next thing I want to do is to kind of show you guys where we are with our BlockFi. So let's see. I did, as you can see, I did 2 crypto-backed loans. I did 1 for Bitcoin, and I did 1 for Ethereum. I basically did that because it was time to upgrade our vehicles, and as opposed to selling my crypto, I didn't want to incur any capital gains taxes or anything like that. Just took a loan for it. As you can see, this one loan is collateralized at basically 1.5 Bitcoin, and the second loan is at 36 Ethereum. The terms are pretty straightforward. Nothing specific on it. Kind of gives you the breakdown of it. I did it at 50% loan to value because, again, I was just starting. I was just learning the process. I was just learning about, the different options and, basically what all that stuff meant. Because when you look at it, it's like, I don't know what the hell that means. So just kind of testing it out. I can say it's a great process, easy, very easy experience. One of the easiest experiences you'll ever encounter in regards to doing one of those crypto type loans. And very simple. Next up, like I said, when I do the new loan for the real estate that we're looking to get into, I'm pretty confident it's going to go through Unchained Capital. So I'll let you guys know how that goes, and I'll make sure I keep you guys informed, because as with everything, we're all in this together. So I try to be very transparent and in the things that I do and how I do it, mainly because of the fact that I'm not trying to sell you anything. I found a great market. I found a great new technology known as cryptocurrency, and it's been amazing. I can honestly say that it's been amazing. So, as with most people who are genuine in their actions and genuine what they do, they look to pass that knowledge. They look to pass that information along. Some people, of course, we live in a capitalistic environment, a capitalistic society. So some people, look to capitalize on that knowledge. But, for the most part, I look at it as there's so much, I'm going to use the table as a reference here, but there's so much on the table. There's so many seats at the table. There's so much room on the table. Everybody can eat. I don't have to take anything off your plate to add to my plate, because at this current moment in the crypto market, there's an abundance. It's overflowing with possibility for everyone. So, I'm definitely not going to be one of those people to where, I'll tell you something a month after I've gotten into it, hoping that you guys will flock over in an attempt to push the price up. I'm not gonna do that. I'll let you guys know what I'm doing as I'm doing it, especially on Tuesdays, because that's why we're here. But anyway, not to go down that road, but I want to thank you guys for joining. Hopefully, again, this was really good information that you guys are going to take advantage of, really put to some good use. And like I always say, you can't get to 1 billion without 1. And right now we're on our way to 1 billion. We started at that 1 and we're working our way towards that 1 billion. So enjoy the ride. Have a good time. Know that I love you guys, and we'll see you next Tuesday. We out of here.